Welcome to Wall Street Prep's Restructuring and Bankruptcy Training Program. The purpose of the program is to provide finance professionals an introduction to the restructuring and bankruptcy process. And regardless whether an in-court bankruptcy or an out-of-court restructuring is the final outcome, investment bankers and consultants engaged in restructuring must understand how accounting, legal, valuation, and capital markets issues all work together to determine outcomes. Bankruptcy jargon in accounting is unique, and this primer lays down the conceptual foundations required to understand all of these moving parts. This primer will be followed by a step-by-step course in modeling a bankruptcy using a real case study. Let's begin. So one of the things that we're going to actually rely on quite a bit throughout this conceptual overview are examples that were laid out in a really great text. I recommend anyone who's pursuing a career in distressed debt, restructuring, or restructuring advisory to get a hold of Stephen Moyer's book, Distressed Debt Analysis. We're going to rely on some of the examples that he's laid out to help us navigate through this introduction. Provides a very intuitive, simple way to understand the space. So let's get started with as simple an example as we possibly can and start building on top of that to get to a more complicated restructuring scenario. So we're going to start with an idea that I think most folks are relatively comfortable with, which is buying a house. So let's say I buy a house as an investment property for $950,000, of which I finance $500,000 with debt, and let's say for the sake of this discussion that this debt is unsecured by the asset itself, by the house or any other collateral, and the remainder is financed with your own money, with equity. So the initial balance sheet. So the goal here of this very, very simple introduction is to just visualize a balance sheet, a very simple one, where the assets are $950,000, liabilities are $500,000, and equity is $450,000. And really, the sole asset here is that house. And in fact, as an investment property, it would probably be labeled as an investment asset as opposed to PP&E, but that's irrelevant for our purposes here. So I incorporate my company and arbitrarily issue myself 90 shares. So in trying to sort of look under the hood a little bit on the equity section, you actually have to assign, when you capitalize a business initially, a nominal number of shares. So let's say I arbitrarily assigned 90 shares for myself, and let's actually say 90,000 shares. Let's keep it all in thousands. Since my equity value is $450,000, GAAP has me record generally accepted accounting principles. Under those, I actually record the value of each share as $5. So $5 per share. I immediately find a tenant, and I realize that I should probably have some cash on hand for everyday maintenance. So I put in another $50,000 of equity, which buys me 10 shares. In other words, $50,000 of equity, since each share is worth $5. Now I've got 10,000 shares. I also purchased hardwood from a vendor that created a payable of $20,000, and so what that does is increases the assets because I now have this hardwood, and it's sitting on the left side of my balance sheet. Let's say, for the sake of this simplified discussion, it sits there as part of PP&E as well. It's going to be categorized as a capital asset. It's hardwood flooring, and we're financing it with an accounts payable. So in other words, we haven't actually paid for it yet. So we have this new $20,000 liability as well. Our balance sheet, keep in mind, is still in balance. Our assets are $1,020, our liabilities are $520, and equity now is $500. At $5 a share, how do we get to the number of shares? Well, $5 a share, the extra 50,000 leads me to issue an additional 10,000 shares, bringing me to 100,000 shares. Okay. Moving away from the house example to a balance sheet of a real company now, let's get some basic terminology under our belt. So, we've been looking at this balance sheet here, and you see the asset side of the balance sheet, you see the liability side and the equity side of the balance sheet. So, enterprise value is a term that we're going to hear quite a bit. You not only hear it in sort of regular modeling and regular valuation analysis, but also in the context of bankruptcy. So, what does enterprise value mean in this particular example? That's gonna be pretty instructive. So enterprise value is always defined, or I should say most of the time, by most folks, is defined as the value of a company's operating assets minus the company's operating liabilities. Couple of things that we should always keep in mind when we're thinking about enterprise value, and that's that cash is often treated as a non-operating asset in the valuation context. And it's actually just netted against debt. Essentially, the treatment is akin to saying I can always use my cash to pay down debt. All cash is essentially excess cash. Whether or not, we know that that's actually not true. The companies do not treat all of their cash as excess cash. But in terms of the way cash is treated in calculating enterprise value and in valuation, essentially all cash is treated as excess cash. So thinking about a net debt figure is really more appropriate than disaggregating debt and cash separately. So any cash that we have on our books, we're basically treating as just something that could at any moment be used to offset any debt liabilities. So based on the definition that we've just laid out above, what's the enterprise value in our example? Well, the value of the operating assets are just the investment asset, the house, and this hardwood flooring. So it's only $970. It's not all of the assets. And it needs to be netted against all of the operating liabilities, not including any financial liabilities. And that's the distinction. So if you take the $970 and you subtract from that the $20, what you get is an enterprise value of $950. And that's an important concept to think about, not just in restructuring, but also in general modeling. That when you look at a balance sheet like this, the enterprise value, assuming, and we'll get to situations where this doesn't hold, assuming, of course, that this also represents the true market value, et cetera, et cetera. The enterprise value is the value of the operating assets, net of the operating liabilities. We're looking at $950. Okay. So notice that the equation assets equal liabilities plus equity can now be re-expressed. That's what we just did using the enterprise value definition as follows. Enterprise value, that's that $950, minus net debt. Let's go back and see what our net debt is. Our debt is $500. We had cash of $50. Our net debt is simply $450. So we're looking at enterprise value of $950 minus $450. That gets us to that same $500 in equity, right? It's simply enterprise value minus net debt equals equity is really a reformulation of the classic, the fundamental accounting equation. Assets equal liabilities plus equity. This is a very common way to discuss value, so make sure that you're comfortable with the basic definitions here. So now let's talk about what I suspect some of you have already been thinking about, which is, well, I thought enterprise value refers to, fair market value as opposed to book value. So let's talk about that. Suppose some time has passed and now I seek to do a large renovation and estimate that I need $150,000. In addition to taking on more debt or putting in my own money to raise capital, I could issue equity to other people, right? So the question now becomes, how many shares should I issue? Recall, I initially valued each one of my 100 shares at $5. But here's the deal. Some time has passed. The business may be different, or I should say, in our case, the value of the investment asset that I have may be different than what it was when I bought it. So let's say I retain an investment bank, and they advise me that in this environment, my business has a post-money equity value of $900,000 because the value of my property increased. We'll talk about specifically what this post-money means in a moment. But let's say, for our purposes for the moment, what we're saying is, hey, we retain an investment bank, Goldman Sachs, and they tell us, your business, the equity value of your business is not the $500,000 that you thought that it was. It's not the $500,000 that you thought it was. We ran a discounted cash flow analysis and we looked at some comps. A business is obviously the value of the equity in a business is a function not of what you initially put in, but it's a function of what folks are willing to pay for it. It's a function of what the cash flows that this investment property may generate in the future is. So we did our own analysis, Goldman Sachs, and we found out that we believe that you have the equity value of your business is now $900,000. And when we say post-money valuation, what we're talking about is assuming that you do receive that $150,000. Remember, I'm trying to raise capital to do certain things, to make investments in my business. I'm trying to do a large renovation. When Goldman Sachs ran their numbers, they assumed in their discounted cash flow analysis, presumably, that you would actually do this renovation, you get this money, and presumably that would generate even higher returns for you. So the post-money equity value is 900,000 because of the value of the property increased, and because most directly because of expectations, presumably about the cash flow, the rent that this investment property can generate. So since 150,000, so now the question is how many shares. That's I guess the question that we've been trying to get at from the beginning of this slide, which is how many shares do I need to issue to get my 150,000? Well, since 150,000 is roughly 16.6% of the total equity value of 900,000. Remember, and now that's why the actual valuation is critical, because now I'm understanding that, okay, if I want $150,000 from someone, I have to give them 16.6% of the new company. All right, well, since I own 100 shares, I will thus need to issue an additional 20 shares. 20 divided by 120, which would be the total pie. That's that 16.6%. So that actually means if I issue 20 shares, and I think 20 shares will be enough to get me $150,000, that implies that each share is expected to fetch $7.50 in proceeds. Okay, and I should say 20,000 shares. That is, I own 100,000. I issue an additional 20,000. That implies that each share is now not worth $5, but $7.50. If I think I can get 150,000 shares for only giving up 16.6% of my business, well, that implies that the value of my equity has gone up. So let's take a look at our balance sheets now. So let's remember our GAAP balance sheet. Our GAAP balance sheet hasn't changed anything other than recognizing that, hey, instead of 500, I now have an extra $150,000 in cash. So remember the old $50,000 in cash that I had here, that goes up to 200. And remember this was 500, that goes up by 150. Let's ignore, we eliminated the AP. So forget the accounts payable and forget the hardwood flooring. For the moment, that's out of the picture again. We're sort of back to the traditional balance sheet. The only thing that's different is we now have an extra $150,000 in cash. So that's where we are. But if you look at a balance sheet from a market perspective, now remember, this is what you'd see in a 10K in accordance with GAAP. But what the market is implying is a little bit different. From a market perspective, what matters is what the market says the equity value is. So the equity is sort of the initial input here. Goldman Sachs is telling us that the value of our business is $900,000, right? And we still have this financial obligation. We have debt of $500,000. So really, the market balance sheet imputes. The market balance sheet imputes the value of the assets. We know that we have cash of $200,000. That's cash is cash. But essentially, an easy way to look at sort of the left side of the balance sheet from a market perspective is really just as an imputation of basically what the equity value is telling us. So we're saying, well, if we have an equity value of $1.2 million and we have liabilities of $500,000, that by definition suggests that we have assets of $1.7 million, right? And we know we have cash of $200,000. So all the other assets presumably are worth $1.5 million. So that's the important distinction that we first made, GAAP versus market. And now you realize that in addition to renovating your existing assets and buying new properties to improve the rental income cash flow, you can also embark on an acquisition strategy and buy businesses with a portfolio of investment properties in geographic areas where you don't have expertise. So this is the next way that you're going to derive some growth for your business. So you've contemplated buying new properties, you've renovated your business, but you can also go through an acquisition strategy. So you find a company that has an attractive portfolio of investment properties that will sell for $200,000. But similarly to what you've seen on your own balance sheet, this company with all these great assets on their balance sheet, if you actually look at their GAAP balance sheet, the value of the asset's only $20,000, far lower than the $200,000 market value. And by the way, how does that make any sense? Well, look at our balance sheet. Our balance sheet has a GAAP-based asset value of $1.1 million, whereas the market is suggesting it's worth much more. Well, a similar thing, but even more pronounced, is happening for this company that we're thinking about acquiring. The market value of their balance sheet suggests a value of $200,000, but the GAAP-based value of their assets is only $20,000. So, so the market's saying it's worth $200,000. To finance the acquisition, you decide to issue $200,000 in debt. That's how you're going to finance this acquisition, and this debt is subordinated to the senior debt. So even though both are unsecured, they signed an intercreditor agreement that essentially subordinates this instrument to the senior debt. Presumably they would do that because maybe these guys are going to be offered, we're going to offer them a higher interest rate. We'll talk a lot more about sort of the various debt tranches and how they work vis-a-vis one another. But that's the capital structure at this point. We borrowed another $200,000 and it's subordinated to the senior debt. Now, keep in mind though that since you only received assets that GAAP values at $20,000, you need to record the $180,000 difference between the purchase price and the asset value as an intangible asset called goodwill. The market loves this strategy. They said, wow, these guys really know what they're doing. They acquired a great portfolio of assets, and your share price shoots up to $15 per share. Presumably the market thinks you're such a great operator that you can really turn this company that you just acquired using your expertise and scale to generate synergies and what have you. And so your share price shoots up from $7.50 to $15 per share. So now let's look at the balance sheet post acquisition. Well, this is your GAAP balance sheet. You just acquired a business that has, remember, you had $950,000 in assets. You just acquired a business that had a book value of $20,000. That brings your assets, your hard asset value, to $970,000. Okay. You took on a $200,000 note to finance that. The excess of the purchase price of $200,000 over the value of the book value for our purposes here of the assets you acquired of 20, that's the 180. 180 represents the excess of the 200 over the 20 they got lumped into here. And so now you have a GAAP-based balance sheet that shows total assets of $1.3 million, liabilities of $700,000, and the residual coming in equity. Again, equity hasn't changed. Equity hasn't moved at all. The market-based balance sheet shows a totally different picture. Since your share price shot up on the news, everyone loved the strategy. Remember, you have 120,000 shares. Your share price shot up to $15 per share. The equity here reflects what the market thinks about your business, which is a function presumably of your future cash flows, etc. So you have equity value of $1.8 million all of a sudden because of this great strategy that you just undertook. And you now have $700,000 in debt, which implies that the market must believe by definition, otherwise they wouldn't bid up your shares this high, that the assets that are underlying in your business, both now your original assets plus the new assets that you purchased, are worth $2.5 million. Well, as you may have imagined, at some point in this introduction, we're going to talk about how the party's over and how things turn south for our beloved company. Well, in the same way that markets can get excited about a company's prospects, they can get unexcited. There's a variety of reasons why downturns happen for a company. That includes company-specific issues, companies just screwing up, industry-specific issues. Maybe an industry is no longer as profitable, and the prospects for it aren't as profitable or promising as they used to be. In fact, our case study, our modeling case study, we'll look at the Borders bookstore bankruptcy, where clearly that's a company that's in an industry that is just getting destroyed by online. So industry-specific issues, as well as macroeconomic issues. The 90s tech bubble and the credit crisis that we all know too well that came 4 years ago resulted in markets changing their opinions about the prospects of many businesses. Even good businesses all of a sudden faced lower cash flows as the general economy deteriorated. So let's suppose that due to a combination of worsening macroeconomic climate as well as company-specific problems, the market is now valuing your business as follows. Equity is no longer worth $15 a share. All of a sudden, the market thinks that all those wonderful assets you acquired from that other company aren't really worth nearly what they originally thought. They don't even think the assets that you had originally acquired are worth much of anything. Your equity is down to 10 cents per share. Remember, you have 120,000 shares. The $500,000 in senior debt that you have outstanding is actually trading in the secondary market by folks at 50 cents a face, at 50 cents on the dollar. The $200,000 subordinated debt is trading at even less because it's last in line. It's subordinated to the senior debt, so there's even less of a chance of recovery if you go bust. So it's trading at 20 cents on the dollar. This implies this kind of scenario where you virtually have no equity. You have the subordinated notes trading at 20 cents on the dollar and the senior notes trading at 50 cents on the dollar. Really indicates that investors believe there's a large probability of only partial recovery to the senior debt and even lower probability of recovery to the subordinated lenders. I mean, it's if you want to get technical, they're saying this is only worth 20 cents on the dollar. It's because we think we're only going to get 20 cents on the dollar. It's only worth 50 cents on the dollar because we think we're only going to get 50 cents on the dollar. Equity value, again, is virtually negligible at this point, close to zero. Now let's look at the gap in the market balance sheet and introduce yet a third way to look at a balance sheet, which is a blend of the two, which is going to be important in bankruptcy. So first, that gap balance sheet that we're all familiar with. Interestingly enough, nothing has changed. The gap balance sheet does not care what the market thinks about your equity, with an exception, and we'll talk about that in a moment. But for the moment, the gap-based balance sheet just doesn't care. Everything is the same as it was before. Barring some exceptions, it does not reflect market fluctuations, so in distress, the balance sheet looks familiar. The market-based balance sheet, of course, looks very different from how I used to. Now, notice the liabilities, the market value of your senior debt is not $500,000 anymore. It's trading at 50 cents on the dollar, so it's really worth $250,000. Someone in the secondary market can go and buy up all that debt, not at 50 cents on the dollar. They'd only have to spend $250,000 to buy it. The subordinated debt, trading at 20 cents on the dollar, well, 20 cents on the dollar, $200,000 obligation, has a fair market value of $40,000. And equity, we didn't even include it. It's negligible. It's basically nothing. So recall what we talked about, the value of assets for a market-based balance sheet being simply an imputation from what the market is saying about the value of equity, and in this case, liabilities as well. The reason why it's trading at such low levels is because we only think there's going to be an aggregate recovery of $290,000. Otherwise, the debt would be trading at a higher level. And so with cash of $200,000, again, cash is cash, that means that all the other assets, all that stuff that we've bought, must by definition, if you look at the market, valuation of the liabilities and the equity supporting these assets, it must mean that it's only worth $90,000 in the eyes of the market. So we have this sort of market-based asset value of $290,000, a far cry from what we were looking at just moments ago. Now, there's a little bit of a difference between liabilities and equity in the sense that liabilities, even though the market is trading, even though owners of your debt, the holders of your debt, can trade it amongst themselves at discounts, you actually have an obligation. It is a contractual obligation to pay the full $500,000 for the senior, to pay the full $200,000 for the sub. So there's this contractual obligation that must be paid. So it's actually very useful to look at liabilities, as at their true face value, but also understanding that since the market is valuing them at below face value, you can understand that you can actually look at the left side of the balance sheet as a market-based balance sheet. You can look at the right side of the balance sheet as a sort of contractual obligation, and the difference, 700 minus 290, reflects how insolvent effectively this company appears to be. This is negative equity in a sense. This means the company is underwater $410,000. And another way to think about this is if the market's telling me that the value of my assets is $290,000 and I have $700,000 in obligations, if I paid off as much as I could is $290. That means these folks are underwater $410,000. In fact, this business is insolvent by $410,000. So this is the context within which companies in distress find themselves, essentially. what options does our company have now? Note that declines in market valuations in and of themselves, by the way, are not the trigger of distress or of bankruptcy. But they do reflect the market's perception or anticipation of distress. Theoretically, in our example, keep in mind, there's nothing that's actually happened. The fact that this company is insolvent in and of itself does not mean that that's it, that they're bankrupt. They could keep operating. Theoretically, as long as our company continues to pay interest, making any principal payments that they need to make, using the large cash balances that it has, there is no possibility of bankruptcy. Barring, again, that the lenders didn't put any covenants or restrictions that say that once your profitability goes down to a certain level, it triggers a technical default and that kind of thing. But barring those kinds of issues, there's nothing that we've talked about yet that is the trigger of bankruptcy. The thing to keep in mind, of course, is that a company that looks like this, presumably the value of his assets are so low because there's no expectation that they're going to generate good cash flows down the road. And if they don't generate good cash flows down the road, they're not going to be able to. So a company that's not going to be able to generate money down the road, cash will run out. That $200,000 in cash at some point will run out, and they will at that point be unable to pay their liability. So keep that in mind. And so again, we turn to what can our company do? Well, some firms have no hope of turning things around and are simply liquidated. And that's a Chapter 7. That's pure liquidation. But many companies are over-leveraged or facing temporary problems, and a restructuring is optimal. In fact, the companies can be fixed. Their problem is not sort of fundamental, and rather it's just an issue of a over-levered capital structure, or there's something happening temporarily that can be fixed. So one obvious way to restructure is to improve the operations of a business. I mean, to the extent that a business is a function of future cash flows, if you improve working capital, if you improve your research and development and improve your profitability, that may compel the market to start valuing the assets more favorably, and of course more substantively, it'll help you generate more cash flows. Now, the reality of it is that companies that find themselves in distress have likely been trying this approach for a period of time. At a certain point, the management will actually retain the Alex Partners of the world, or the Alvarez Marsals of the world, these restructuring shops, these restructuring advisors, to help them navigate through those operational issues and how to improve things. So let's say in our example, an example that we've had up till now, that let's say you were able to improve operations to the point that the market actually believed that the value of your assets is $700,000 in total. Well, the truth is, so that's good, but even at this valuation, for example, it should be noted that you're basically levered 100% debt, 0% equity on a market basis. So almost inevitably, unless you can really turn things around, it leads companies to the next option, which is a restructuring of their liabilities. So another option is to convince or compel the lenders to exchange their debt for equity. Okay, so in our scenario where now the market's tanked, it's $290,000. So again, let's ignore this improved operation thing. We're back to this original example where the market is valuing us at $290, and let's say you were able to compel, or let's say convince. We'll talk about out of court restructuring or a voluntary restructuring first. So let's say you're able to convince the lenders to exchange their debt securities for some equity. So let's say lenders, seeing the writing on the wall, can be convinced, because they know that if they keep insisting on these kinds of payments, the company will just declare bankruptcy and give them pennies on the dollar anyways. So and this is foreshadows one of the things that we're going to talk about in a little bit, which is that the out of court process is very much informed by the potential recoveries in an in-court scenario. So under this scenario, lenders seeing the writing on the wall can be convinced to exchange their existing claims of new debt their existing claims of new debt and equity securities that put the company in a more sustainable footing. The balance sheet will be restructured. So the negotiation. So let's actually look at the numbers here. Let's say they're able to say, you know what, we're going to give up our $500,000 in claims. The subordinated folks are willing to give up their $200,000 in claims. The senior debt folks agree to take $100,000 in a little bit of equity, and the subordinated folks agree to take a little bit of equity. Well, now you've got a much more sustainable looking balance sheet. So now the question here is, should the subordinated lenders who appear wiped out receive any fraction of the equity? This is going to be a big point, as you can imagine, a big point of contention. Who, the senior debt will say, hey, you guys owe us $500,000 worth of value. There's only $290,000 worth of value to go around. We should not only get the new note, but we should get all the equity. Now the question is, what will the subordinated lenders do? Okay, so with that, we got to the end of our section here. In the next section, we're going to talk about the various scenarios and the various options that are available to the various providers of capital in both an in-court and an out-of-court restructuring.